Good morning. So today I wanted to talk about why, for the majority of people, it will be bad if they purchase a home in 2023, right? So before I get into why it will be bad for most people, understand that interest rates for the last 15 years, since right around 2008, moving forward, were under 5%. And then with the event in 2020 that, swept the nation and had everybody wearing masks, they were actually below 3%. So for a long time, we enjoyed under 5% rates, under 4% rates, right? And then right around when I started to get moving and grooving, that's when everything transpired, and now rates are going right back up. And understand that there were times, especially in the 1980s, where rates went from 11% to 18%. And guess what? Transactions were still being made. But here's the thing, transactions were probably being made by the people who had a lot of assistance in forms of grants, right? Or people who already had homes and were able to sell off their home with existing equity and purchase something slightly better, and understand that prices were nowhere near what they are today. So you can look at a $90,000 home in 1980, and try to compare that to a home now today, where the average is around 430,000, right? You're not going to have good luck at 18% interest rates. For an example, a $215,000 home, depending on your taxes, of course, in 2021 would have cost you about $1,300 a month. Now that same home will cost you right around $2,400 a month, and that depends on the down payment. Obviously, I was calculating it as maybe a VA loan, zero down to let's say 10% down, because I would never suggest 20% down. 10% gives you better rates than 20%, and if you do want 20% afterwards, just put the extra 10% after closing to get rid of the PMI. All right. I'm pretty sure somebody didn't want to listen that far after I said don't put 20% down, because the banks do not honor you or respect you as much in terms of your rate when you put 20% down. You actually get a better rate at 10 or even 5% down. And it's because you have PMI that the bank feels more comfortable giving you a slightly lower rate. Without the PMI, there's more risk to them, even though you have more cash, and therefore you get a higher rate. And it's even more lopsided now with the changes to how loans are going to be financing mortgages. So they're really updating that now. And you're going to see, if you type in any mortgage calculator, while your interest rate is lower with 10 or 5% than it would be at 20%, which is ridiculous. I personally believe that's ridiculous. You should award people who put more money down, but they don't. So the goal is put 10% down and then put the other 10% after closing. If you have 20% and you want to get rid of your PMI, that's how you do it. And in return, you'll also be shortening the years on the home as well. So it's a win-win in that regard. And that also means that you have more control of the home. You're not overspending on the home. You're not purchasing a home 20% down at 47% of your income to debt ratio. You're purchasing a home that you can afford even at 10%, and then you're foregoing an additional 10% in order to get rid of the PMI. So that means that you're definitely a well-qualified buyer, and you'll be able to pay this home off easily over the coming years, as long as you have stable income And that's honestly all you really need, and good health, I should add. So most people are not investors. Most people are going to buy a home as their primary residence. What I've heard constantly is job layoffs. I've talked about it. I've continued to iterate it. I've continued to say save money for opportunities, and save money because of situations like this. You don't want to be in a situation where you're unable to afford your rent, needless to talk about your mortgage, because you're now in a situation where you've been laid off. Because again, banks cannot afford to pay jobs cannot afford to pay every tech worker $100,000 a year. And a few months ago, nobody would have said that. Everybody would have said this is just the age we're in, and this is how much you pay a tech worker. But now, these layoffs are coming because businesses have realized they don't need as many people to do these jobs. And, they were overhiring, overspending, and now they have to get back to some sense of normalcy, some sense of reality. And so you don't want to buy a home as your primary residence with no assets, only liabilities. Assets are money that comes into your pocket. Liabilities is money that comes out of your pocket. A lot of people will tell me that a home is an asset regardless, because you're paying less in rent than you are your mortgage, and you're gaining equity. I would disagree, because as long as you have cash, as long as you're cash negative and not cash flowing, you have a liability. You have something that is not earning you an income. You can turn a home into an asset by renting out a room, gaining cash flow. And honestly, some homes are not meant to be assets, right? Some homes are meant to be liabilities. And the way you get around that is by having more assets than liabilities, having more income than debt, right? And a lot of people make the decision, even if they're an investor, to buy a home that's even bigger than all of their assets. So maybe your primary residence costs you $4,000 a month, but all your assets combined after cash flowing make you $1,000 a month. Your assets are still less than your liability, but because you want to live big and lavish and you got this extra $1,000 in income, your liabilities outweigh your assets. And this is typical. This is seen often. That's why most investors only have one additional home, one additional investment property. And so you have to look at it. You got to see what the normal people do, what the average people do, and then you have to say, I'm not going to be average. And honestly, I have followed that method throughout the entirety of my time since I've graduated college, and it has worked wonders for me. I have made $500,000 in just 1 year, right? So I'm trying to inform you and teach you that if you want to be successful, just listen to the millionaires. Listen to the people who are doing the opposite of what everybody else is doing. Listen to the people that you want to be with. I've just talked about that in previous videos. Again, if you're buying a home that is not an investment, that is not going to cash flow, that you think has already appreciated to its full potential, that you can't really do an add to this home to increase its value, then you are completely going to be crushed. I do believe that interest rates will go down, not in the short term, but in the long term, especially in the winter months, when people realize that they simply cannot afford a home. Or if interest rates stay where they are or go back down to 6% by December, by January, at the very least, you'll see a discount in prices. You're not going to see that in the summer seasons like April, May, June, right? You're not going to see that in July. July is going to start to bottom out a little bit. But by August, you're going to see $5,000 price cuts, $10,000 price cuts. September, you're going to see more of that. October, that's probably going to be the time to strike when the iron is hot. November and December, those are going to be golden, but there's going to be less properties available in November and December because nobody really wants to sell their home in November or December knowing that there are going to be less buyers in the market. So again, summertime is not the best time to buy. I am not average, and so I never buy in the summertime, although they typically have more homes available and more options to choose from. There's also more people in the water. You're going to be competing with more people. Mark my words, if you want to compete for every single listing, compete right now in April, May, and June, and even July. You're going to be competing. You're going to go over asking price on any home that's worth a little something. So unless you're being creative, unless you're doing rehabs, unless you're adding value, you should just stick to the sidelines, stick out of this market, because again, you're going to be spending a ton of money, and I don't think appreciation will be going up for the next 2 years at a rapid incline, right? We're seeing interest rates kind of stifle that a little bit. It hasn't really stifled the Midwest market as much as you might think, but I don't really foresee 2020, the late 2023, late 2024 prices going up that drastically, if at all, right? Maybe another 5 or 10,000, but for the most part, I do see most areas are going to start to take a little hit. Even the great properties have been taking a little bit of a hit, but the superb properties, of course, those will always sell. Those will always maintain their value. There's always a buyer in every market who can pay anything for the home that they want to live in. And so you have to do your due diligence and understand that, again, you don't want to really be competing with people at this time, right? If you want a superb home, it's going to be hard to find in October, November, and December, but you're going to have less competition, and it will be easier for you to negotiate at that time. So if you prefer more money in your pocket than the biggest home, you should definitely stick to the sidelines. If you prefer to have less money in your pocket, I'm not going to go out there and say you're going to be broke or anything like that. No, I won't go to that extreme. But if you prefer less money in your pocket, then definitely go out this summer and try to buy a home. And you will find yourself spending at least an additional $400 a month if you're going for the average type of home these days in any market. All right. If you like this video, make sure you leave a like, comment, and subscribe. You know I post every single day at 8 a.m. daily, and I can't wait to see you on the next one. Peace.